in terms of when it reduces, okay, when the interest rates get a cut, let's say there's a rate cut, okay, and why would they do a rate cut? There's only two levers that that the Federal Reserve plays on, okay, for the whole economic cycle to happen. One is if the inflation is quite high. What do I mean by inflation? Inflation means the prices of products are going very high, okay? That means, in other words, what it's saying is that what $1 can get you in terms of a product is going very low. That's the final effect of inflation, okay? It's like, to give you a nice example, if you talk about back in the 1960s, to get a taxi ride or a cab ride or a bus ride or a train ride was much lesser, wasn't it, right? So your £1 or your $1 can go a long way, right? But today, I mean, you can't get anywhere with £1, especially here in London, right? So that's what we mean. So when inflation happens, okay, the value of the dollar or any currency for that fact starts to reduce because it's not able to go that far, okay? So now, to reduce then inflation, what they would then do is increase interest rates, okay, curb down on the borrowing, right, so that the consumer spending will go down, okay. However, on the other side, when they do rate cuts and everything, right, what they are really actually doing is that they're encouraging borrowing to happen, okay, borrowing to happen so that then the economy can then move up. Especially if you take a look, traders, very big companies, right, very big multinational companies will take some borrowing, okay, from the banks to then expand their infrastructure, innovation, marketing, all of those kind of stuff, recruitment and all that. So to sometimes boost the economy, sometimes they do rate cuts to bring it all the way back up again, okay. So that is the whole idea of why they do rate cuts, okay, or increase the interest rate, okay.